Welcome to the deep dive. Today we're digging into something foundational, something that really separates the pros from the crowd. We're looking at the core teachings from month 2 of the 2016 mentorship.
Yeah, this is the material that forces you to shift your entire perspective on what trading actually is.
Exactly. Our mission today isn't to chase some hot signal. It's to really understand the fundamental process of building wealth with very, very low risk.
Which brings us to the big paradox, right?
The big one, that professional trading, when you do it right, is actually supposed to be boring.
Profoundly boring.
Mm.
It's not a lottery ticket, and that is the first mental hurdle everyone has to clear.
So it's about fighting that impulse.
It's all about fighting that impulse. The market rewards patience, but everything you see online encourages you to rush, to chase these massive pip gains or huge percentage returns overnight.
And taking huge risks to get them.
And that's the killer. You have to suppress that desire. You have to understand that the real key, the real shift, is in focusing on small, consistent percentage returns.
Letting the math do the heavy lifting.
Precisely. You let small, well-defined trades compound your equity over time. The goal is long-term financial fluency, not a lucky guess.
Okay, let's unpack that. I want to get right into the numbers. If we're talking about low-risk growth, what are the core aims we need to have in mind?
So there are a few core principles. First, you have to determine a realistic reward-to-risk model, a favorable one, your RR. But here's the psychological flip. You have to learn to respect the risk side of that equation more than the reward side.
The risk comes first, always.
It's your insurance policy. The entire institutional approach is built on identifying setups that give you a minimum of 3 to 1.
3 reward multiples for every 1 unit of risk.
Exactly. A 3.1 RR or higher, that's the floor.
And why 3 to 1 specifically?
Because it's a mathematical backstop. It ensures that even if you take, say, 2 losses in a row, one single win can cover those losses and put you back in the green.
So you're framing trades where if they go wrong, the damage is just negligible, it's a cost of doing business.
It's just a cost. Now let's zoom out to the actual goal. Because people hear low risk and think low returns.
Right, they think it's slow.
The material lays out a target that sounds incredibly modest. The goal is to aim for 6% compounded per month.
6%. Okay, I can already hear people thinking 6%, that's it. Explain why that number is so powerful.
Because people are terrible at projecting compounding over time. That 6% a month is it's actually very achievable.
How achievable? What does that look like on a weekly basis?
You'd need only about 20 profitable pips a week. That's it. If you're using a simple 1-to-1 RR at 1.5% risk, that's not a huge ask.
And that conservative 6%, what does it do to an account over time?
It doubles your account every single year.
Let's run the actual math for everyone listening. You start with, say, $1,000.
A modest $1,000 account.
You hit that 6% a month consistently, and you never add another penny of your own money. In 10 years, that $1,000 becomes
over $1 million.
See, that's the shift. It's moving from lottery ticket thinking to process-driven compound growth.
And this is where it gets really interesting. Because there's this huge myth in trading that you have to be highly accurate. You need an 80% win rate.
But you have to be right all the time.
The data just proves that's not the case. Accuracy is way less important than your RR.
Okay, so break down that relationship for us between win rate and RR.
Think about it. If you have an amazing 75% win rate, you actually only need a tiny 0.3 to 1 RR just to be profitable.
Which is not great, but you're still ahead.
You're crawling into profit, yeah. A 50% win rate needs a 1-to-1 RR just to break even.
That makes intuitive sense. Half wins, half losses.
But here is the real revelation. It's what happens when your accuracy is low.
Which, let's be honest, is where most people struggle, especially when starting out.
Exactly. The key insight is this. A trader who is only 25% accurate.
So you're losing 3 out of every 4 trades.
75% of your trades are losers. You only need a minimum 3.1 RR ratio to remain profitable.
Wow. Okay, so that just takes all the psychological pressure off, doesn't it?
It completely reframes the goal. It's not about being a perfect predictor. It's about being an efficient risk manager.
Let's use that $5,000 account example. Let's say you take 10 trades and you only win 3. That's a 30% win rate.
A 30% win rate. And let's say you're disciplined. You only take trades that offer that minimum 3.1 RR. You risk 1% per trade, so that's a $50 loss.
And a $150 win.
Right. So your 3 wins bring in $450. Your 7 losses cost you $350.
Net profit of $100. That's a 2% return on the account.
You were wrong most of the time, and you still grew your account.
Now, this is the kicker. What happens if we keep that same, pretty miserable 30% win rate, but we just get better at framing trades for a higher RR, say 5.1?
Okay, so same 1% risk, $50 loss. But now your average win is $250.
3 wins now brings in $750.
You subtract the same $350 in losses. Your net profit is now $400.
That's an 8% return. We went from 2% to 8% without getting any better at predicting the market.
All you did was change the kinds of setups you were willing to take.
Yeah.
That is the definition of trading efficiently.
Which raises the big question, Rhea. How do we actually find these setups? Because it's easy to say find 5.1 trades, but where are they?
That's the perfect transition. We've got the math, now for the execution. And it all starts with bridging the gap between the high time frames and the low time frames.
HTF to LTF.
Exactly. The foundational rule is that the higher time frames, monthly, weekly, daily, they have more weight, they have more influence.
Because that's where the big institutional money is leaving its footprints.
That's where the banks are operating. So we have to start there. We identify a key high time frame level, like a daily order block.
And just for clarity, an order block is that specific candle that shows a huge institutional buy or sell before a big move.
It's their signature. So once we find that daily order block, the key is we then transpose that level down to a lower time frame, like the 15-minute chart.
Why do we do that? What's the benefit of going down to the 15-minute?
It's purely tactical. It allows for a much, much smaller stop loss.
So you're minimizing the R in the RR equation.
You're shrinking the denominator.
Yeah.
And that automatically maximizes your potential reward multiple without the market needing to make some gigantic move.
Let's walk through an example. Say, AUD/USD. We see a daily bullish order block forming at, 0.7512.
Okay, so that's our area of interest. Then we look for a catalyst. Maybe we see a classic turtle soup condition.
Price sweeps just below an old low, grabbing liquidity, trapping sellers.
Perfect. Now, the amateur trades that on the daily chart with a 100-pip stop. We don't do that.
We transpose that zone down.
We go to the 15-minute chart, and we find a specific 15-minute bullish order block inside that larger daily zone. That's our entry point.
And the stop loss.
The stop goes just below the midpoint of the daily block. So now your stop might only be, say, 17 pips. That tight stop is how you can target a normal market move and still get a 3.1 or 5.1 payout.
That brings up trade management and the psychology of it all. Because even with a great setup, you're still going to take losses.
And you have to be okay with that. A professional equity manager sees losses as a cost of doing business. It's not a personal failure. It's just part of the model.
So how do we manage a winning trade to maximize this low-risk model? The key here is taking partial profits, right? Not being binary.
You cannot be binary. The all-or-nothing mindset will kill you. You have to pay yourself when the market makes profit available.
So walk us through a specific strategy. Let's say we enter with a 2% position size.
Okay, a 2% risk. Your first target should be that modest 3.1 RR objective. When price hits that, you take the first 1% of your position off the table.
So you sell half the trade.
You sell half. By doing that, you've just banked a 3% return on that portion, and critically, you've removed 50% of your original risk. The rest of the trade is now effectively risk-free.
You're playing with house money. I love that. So what do you do with that second half?
That second half, the remaining 1%, you let it run.
For a much bigger target.
For a much higher time frame objective, a big liquidity pool you've identified on the hourly or daily chart.
Yeah.
And that second portion of the trade, if it works out, will always make more than the first.
That's the difference maker.
That's how one single low-risk trade can suddenly produce, a 9R or even a 15R return.
Yeah.
You lock in profit, neutralize risk, and then let the runner go for the home run.
This brings us to, I think, the holy grail of this whole approach. Finding those truly high-reward setups, it's not random. There's a process.
There's a very specific, structured process. It's the 7-point framework from the source material. This is the checklist for when you really want to have high conviction in a trade.
It demands alignment across 3 different perspectives. Let's take this slow because it's dense.
It is. But think of it as layers of validation. First is the big picture perspective, the macro drivers.
And for this to align, we need 2 out of 4 factors to agree, right?
That's right. Number 1, macro market analysis. Is the environment inflationary or deflationary? 2, interest rate analysis. Is the central bank hiking or cutting rates?
Okay, makes sense.
3, Intermarket analysis. What are correlated assets like the CRB index or the dollar index doing? And 4, seasonality. Does this pair have a historical tendency for this time of year?
So you get 2 of those 4 pointing in the same direction, and you have your big picture bias. Then we move to the intermediate perspective.
For this one, we need 2 out of 3 components to agree. First is top-down analysis. Are the monthly, weekly, and daily chart levels all in agreement with our bias?
Second is COT data.
The Commitments of Traders report, yes, we're looking for extremes. Is smart money, the commercial hedgers, at a historically net long or net short level?
And the third?
Market sentiment. Is everyone, the media, retail traders, are they extremely bullish or bearish? Extreme sentiment is often a contrarian signal.
Okay, so if we have the big picture and the intermediate perspectives aligned, we get to the final layer, the short-term perspective. This is about timing the entry.
This is all about execution. And here we need one confirmation from each of 3 specific categories.
The first is correlation analysis. You're talking about SMT divergence here.
Smart money technique, exactly. We're looking for a divergence between highly correlated pairs, like eurodollar and pound dollar. It tells us which one is leading the real move.
A very subtle confirmation. What's the next category?
Time and price theory. Is price reacting at a key time of day, like the London Kill Zone or New York Open? Is it respecting the logic of the quarterly or monthly ranges?
And the final, most esoteric one, IPDA.
The interbank price delivery algorithm. In plain English, we are looking for a clear run on liquidity.
A run on an old high or an old low.
Exactly. Price moves to that liquidity pool, grabs the orders, and then reverses sharply. That shows us the smart money has engaged and is driving price in our direction.
So a true high-reward setup requires all 3 perspectives. Big picture, intermediate, short-term, all greenlit. That's a total of at least 7 points of agreement.
That is what gives you institutional-level conviction.
Which means we also need to talk about the traps, how the market makers specifically target unprepared retail traders. Let's talk about false flags.
Yes, this is a big one. Most traders learn classic textbook patterns, right? A bull flag or a bear flag.
A continuation pattern. You see a flag, you expect the trend to continue.
But these patterns fail a lot. And they tend to fail in very specific contexts.
When the trend is already very mature?
Or when price has just run into a major higher time frame level of distribution, what we call a premium or accumulation, a discount.
So let's just quickly define premium and discount.
Simple way to think of it. A premium is the expensive upper end of a trading range. Institutions want to sell there. A discount is the cheap lower end. They want to buy there.
So if you see a perfect-looking bull flag form right up in a premium area,
it's probably a trap. The market uses that pattern to generate excitement, to suck in breakout buyers.
And then what happens?
Price will often just poke its head above the flag's boundary, just enough to trigger all those buy stops.
Right.
Another turtle soup, and then it reverses, hard. The breakout traders are trapped instantly.
So the key is using that whole 7-point framework, that HTF context, to know when a classic pattern is actually a liquidity trap.
That's the entire game. It's about process and context over simple patterns. It's about efficiency, not perfection.
So the overall lesson here is that real consistency comes from a robust framework that forces you to define risk first.
And confirm your bias with multiple layers of institutional-grade data.
Okay, so let's give everyone listening a clear challenge for this week, a way to apply this immediately.
Let's do it.
Your challenge is to choose a currency pair. Go back on the historical charts and establish your big picture and intermediate perspectives using those frameworks we just outlined.
Do the macro homework.
Do the homework. Then dive into the daily and hourly charts and look for specific instances where the market formed a false flag, a classic flag pattern that failed in reverse.
And then ask the important question.
Did that reversal happen right near a daily order block or some other high time frame liquidity pool that would have justified the reversal?
That's the analysis that builds real skill.
And we'll leave you with this final thought. If you can master that 7-point checklist, if you can frame your trades for a minimum 3.1 RR, and if you can finally accept that paying yourself early is a strength, not a weakness,
then what kind of return are you capping yourself at right now?
Simply by focusing on vanity metrics like pips instead of the real engine of growth, compounding. Something to think about until the next deep dive.